Well, welcome to the lecture on financial and investment basics. This will probably be the most important lecture in the entire class outside of what we're going to be learning about investment plans later on. But it is going to be a rather lengthy lecture today, so please sit back and relax. You may want to digest this in some parts. We're going to be covering some of the areas that have been introduced in the textbook and the supplemental reading. But I want to make no assumptions that you understand some of these concepts because that's what this class is all about. It's about the basics, not about intermediate or advanced level understanding. It's about the basics. And the good news is that most of us only need to know the basics to be very successful in investing. All right, so like our previous lectures, I'm going to take more of a definition approach and have those definitions build on concepts as we kind of walk and talk through those. So let's take a look at them and get started here. So the first one I wanted to start off with is a word that's been used a lot in our reading and supplemental readings, and that is portfolio. What is a portfolio exactly? Well, it's a rather loose term, but really it means anything that's in your investments. Anything. It could be your retirement plans. It could be other investment accounts that you have. But the concept of portfolio is the way it should be applied is that it is a cohesive approach. So whatever it's a bucket, if you will. So whatever's in the bucket is really up for determination. But that bucket itself is the portfolio, and it should kind of act as a single entity with a purpose. But what you can put in the bucket is pretty crazy. I mean, you could put gold, you could put real estate, you could put all kinds of exotic investments in there, and retirement plans and other things. Even it can run the spectrum. But for most of us, it's going to be for most folks, it's when we say portfolio, it's that portfolio of your traditional investments. And again, for most of us, that will probably mean the largest portion of what would be considered a classic investment will be our retirement plans and then other investment portfolios that I guess we may have outside of retirement plans too. So that's what it is, kind of a generic term. All right, the next terms I want to get into is investment versus speculation. And this is really a fundamental thing for you to grasp. Now, you'll hear things on TV, internet, wherever, about, making money in the stock market, day trading, or buy this stock because it's hot now. And all of that kind of information is centered around speculation. And speculation is a really pretty word for gambling, quite frankly, especially when it comes to these investments. You're really taking a blind leap of faith, and it's often off of a cliff when you're doing speculation. Speculation can be fun. It can be fun. It can be exciting, just like going to the casino can, for some people, is fun and exciting. For me personally, it's not because I know that casinos are built on what we've lost, and they make tons of money on what people have lost, and they are absolutely skewed for you to lose. And speculation is more often than not a loser's game. If you were to ever do speculation investing, know that it is. I would approach it from an entertainment point of view. If you do it at all, my recommendation is to avoid doing it. But if you wanted to dabble, that's what you would do. And know that if you ever lost, if you were to lose anything, would you be okay with that? And it wouldn't hurt you, your financial livelihood, and that of your family. Okay, so speculation is gambling. Speculation is short term. I don't even want to say investing, but they call it short term investing is speculation. What is investment? What is investments or investing? That is a fundamental belief that you believe that economies generally are going to grow. That the economy in the United States, domestically, you might hear that word, domestic means the United States because it's domestic to us, or international or globally, that these economies, that basically human endeavors are going to grow, and that you want to participate in that growth. And historically, human endeavors, businesses, the things that we do have grown over time. There have been periods of retraction, depressions, recessions. There have these have occurred both in modern times and going back in other times as well. There were economic collapses, much more regionalized, but they can happen, but they're usually short-lived. And then there's a period of prosperity that will continue after that. So, do you believe really in the prosperity of humanity? If you say no, I don't believe that humanity, I think humanity has reached its peak right now and is not going any further. Well, if you believe that, then investing may be a hard concept for you to believe in. But I think most of us believe things will be better off. There'll be ups and downs, but there's more ups than there are downs with the general endeavor of human nature. And that's either whether building businesses or technology or whatnot. Those things will continue to grow. And you want to participate in that. And that is what investing is, that you are participating in that. It's also hallmarked by a much longer term perspective. You're not worried about months, days, weeks. You're really looking at years. So taking that perspective in what you're doing is investing. And you also are taking a thoughtful approach to how you do that. So hopefully you can see the difference between investing and speculation, or investment and speculation. The You'll run across folks who say, "Oh, the stock market is risky." Well, the stock market is risky, especially in a short term. Guaranteed, absolutely short term. Long term, not so much. Not so much. And when people say the stock market, they usually refer to the U.S. stock market. But even when you look at global stock markets and kind of blending all of those together, again, generally human endeavors march on, and things grow and things do get better. All right, so there's the difference between investment and speculation, and I hope you're all investors and not speculators. And if you are speculators, only do it for fun. Stocks. So what are stocks? And you might hear this other term, equity. Same thing. Stocks and equity, pretty much synonymous with being the same thing. What is a stock? A stock is a percentage of ownership in a company. So a company, let's say you start a company in your basement, and you're making you've got this wonderful product. You've invented some new widget, that just works great, and you start the company, you start building, you start selling, and you're making money, and then you start hiring employees, and your company grows and grows and grows, and you're the owner, okay? And now you've got 3,000 employees, and you got multiple factories now, and things are going great. And the investment bankers come to you and say, "Hey, have you ever thought about going public?" And what that means is basically you decide to sell your company to the public. And how do you sell your company to the public? You issue shares of stock. Those shares of stock are little percentages of ownership. Now, if I owned 100% of a company in their stock, I own it all, I can make all the decisions. That's what's kind of cool. I have voting rights. That's what's kind of cool. Voting rights for what? Well, you have voting rights for the board. There's usually a board that will run a company, make decisions on who's hired for the CEO, who's fired for the CEO. And if you owned all of the stock, you 100% ownership, you could basically vote out the entire board, hire your own board to do the things that you want to do, and hire the CEO that you want to hire. And this is actually done. If you have large percentages of ownership in a company, you can kind of control that company, which makes sense, right? You'd want to be able to. If you own portions of the company, you get that. What's in it for the company to go public, to issue stock? They get, you might hear this, we're going to talk about this word, but capital. What's capital? Capital is money. So let's say, you're that owner and you decide to go public. There's some things in it for you, personal wealth creation. You could have that. and generating additional funds for the company, maybe to fuel expansion. So you sell your stock and then you'll get money for that. And you can build new plants, invent new things, whatever you're going to do. So that's one way to raise capital is to issue stock out. What is stock? I mentioned stock gives you voting. You actually get little pieces of paper in the mail and you get to vote on things when you own stock. You actually get these little proxy statements and you can mark boxes on who you want to be on the board. So that is kind of cool. Even if you own one share of a stock, you get those voting rights. What else it entitles you to? Well, you're the owner of the company, so you are entitled, or may be entitled, to the income generated from that company, and you get that through dividends. So you actually get a check in the mail. The company's done well. Let's say they've made $1 million. You will get your portion of that, or whatever dividends that the company wishes to declare and give back to the owners, because they might need some of that money to keep business growing and whatnot. They won't give all the money they've made away, just like you've got to save some and invest in themselves on new equipment or whatever they're going to be doing. But they will give some of that back to their owners in the form of dividends. So that's kind of cool. You actually get little checks in the mail, sometimes big checks, depending on how much stock that you own in the company. So that is kind of what stocks can be. It's really a percentage of ownership in that company that gives you a certain control of it. What are the risks? Well, since you're the owner of a company, even a small percentage of it, if the company goes bankrupt, you got nothing. You have no claims on the company. You can't get anything back. It could go down to zero value, and you've got nothing. So keep that in mind when you buy stocks. What is a bond? A bond is basically a loan. They're very different than stocks. But let's say you're that big company or a little, and you need money, and you want to build a new factory, but you don't have the money. But you know this is going to be a great factory. You really want to build it. Well, how do you get money? Well, you can go to the bank, say, bank, I need $20 million to build a factory, or you can skip the bank and ask the people directly. I need money, and I'm going to pay you interest if you lend me the money. Skip the middleman. That's what's nice about bonds, is that you skip the middleman. They go directly to the people or investors for that money. Investors then get paid back what they lent the company over time, and they get paid back interest because they got to do it. There's got to be something in it for me. I'm not just going to give you $10,000 and then get $10,000 back. I'm going to give you $10,000 and I'm going to want $11,000 back. So that's kind of a nice way for folks to participate it, with a company, and for the company to skip the middleman, the bank, because the bank obviously uses your money. They act as that middleman. They'll use your money from deposits and other things that you may have with a lending institution, and then filter it, and then take their cut, and then move it on to the other entity who needs the money. And whenever you have that middleman, it's costing you a little bit more. So bonds are a much more cost-efficient way for a company to raise money for big projects. Bonds, they actually have terms on them as how long they last. So it might be 10 years, might be 15 years, might be 5 years. It could be 20. So just like a loan. Again, they're going to you for that money, and your interest is typically paid back throughout the year. So you'll actually get little interest payments throughout the year, and then at the very end, when the bond is due, it's over. Let's say it's 10 years from now, then you get your original amount that you put back. So you got all that interest over the years, and you got your money back, your original principal. Now, what's the downside? What if the company goes bankrupt, disappears, pulls a Sears, which will probably happen? They totally go off the face of the earth. What happens to you? Well, as a bondholder, most bondholders have a unique claim against the company. You actually have a claim on their assets. So if they start selling their stuff off, let's say their factory equipment, they start, all right, we're bankrupt, but we're selling everything, liquidation sale, bankruptcy sale, they start selling their equipment. They may have even intellectual, I guess, property. Um, let's say they have a great patent, a great design. They could sell that. They'll sell all kinds of things. Basically, they'll go down to zero. They're required in most bankruptcies. The real bad ones, they're required to go down to zero. There's not going to be a workout phase, and you have a claim to get some of that back. So you might get some of your money back. You probably won't get it all back, but let's say you gave them $10,000, and you might be lucky if you got 2,500 back. After it was all said and done, and the company liquidated. When you look at bankruptcy, well, why didn't I get all the money back? Well, bankruptcy basically says I have more debts than anything I'm worth. So you got to remember that. They've already maxed out, owe more to people than what they can possibly generate or have any worth. So remember, that's why you're not going to get all of your money back in the worst case situation, or you get nothing. You'll get nothing at all. But at least you have a claim where the people that own stock do not have a claim. They don't get anything back. That's the advantage of being a bondholder. The disadvantage is you have no say or control over the company whatsoever, where stock ownership, you do. So there's much more upside potential long term in being a stock owner than there is of being a bond owner. But the bond owner, you have some protections afforded to you, and bonds are far less volatile, far less subject to fluctuation in price because of that. They're less risky. And risk is defined really as volatility, how much it moves up and down. Okay, so there's some essentials on what stocks and bonds are. Mutual funds. What is a mutual fund? We've heard about these all of our lives. Mutual funds are really an investment company will buy individual stocks in a portfolio, if you will. So they'll have hundreds, maybe thousands of different companies, and they'll go buy those individual stocks, and then they will pool them all together into a bucket, into a mutual fund. And each mutual fund has its own spin, has its own kind of marketing preference. Maybe it's a more higher risk mutual fund. Maybe it's all international. We'll talk about those in a moment. Maybe it's an indexed mutual fund. They have a unique branding for each one of them. But what they allow you to do is to be able to purchase a share of that mutual fund, which in turn is backed up by perhaps thousands of stocks, and maybe even some bonds too. It really depends on the mutual fund, but let's say thousands of stocks. And for you to go out as an investor, I mean, we can't do it. Most normal people cannot go out and buy hundreds of stocks of different companies. It's just way too costly. And the management to control all of that you'd have to basically be a full-time job. It just doesn't work. Mutual funds allow us to do that very easily, to participate in that. Now, so let's say you buy a mutual fund and you invest $100 and there's 1,000 stocks in there. You obviously don't own a full share of any stock. So there is no the stock ownership doesn't pass through to you, but you are represented within that pool of those stocks. You have a certain percentage that is yours. So again, a nice way for folks to get into what we'll call diversification, and we'll talk about that in a moment too, relatively easily. So that's what mutual funds are. They're a really great way to go for investments. The other thing you're going to hear about are exchange traded funds. These are somewhat like mutual funds in that behind the scenes, an investment company is pooling together a bunch of individual stocks. There are some unique differences though. Exchange traded funds, you can buy one and you can sell it throughout the day. So that makes it kind of unique. Where mutual funds, you can only sell at the end of the day. Now, what difference does it make? Well, for most folks, it really doesn't make a difference. You're not really caring too much whether you can sell at 2 o'clock or sell at 10 o'clock, 10 p.m. Or 10 a.m. You don't really care about the time of the day. So, and that's really shouldn't be, if you are worried about that, most likely you're taking the wrong approach with investing. They do tend to have a lower fee structure in that how much it costs to maintain them. But the flip side is because they are traded, that you have to actually, buy something and sell something. Each time you buy and sell within a market, there's going to be a cost for that. So sometimes it kind of outweighs itself, by, yeah, they're a little bit cheaper to maintain, but there is some cost involved with kind of getting in and out of these exchange traded funds. So my general thought is for most folks, mutual funds are the way to go versus exchange traded funds. They um, they have some features in there which make them a little bit more friendly for more investment minded individuals. Not to say that you couldn't do exchange traded funds; they could work perfectly well, but in my opinion, I believe the mutual funds are probably the way to go. But they're very, very similar. So just know that you couldn't make a dramatic or drastic mistake by going one way or the other with these type of investments. Know that both of them, though, behind them have a portfolio that's either being actively managed or managed by a robot. So it's a way to participate in getting that diversification of hundreds of or thousands of different types of stock and in a very easy and affordable format. Okay, no load funds. You'll hear this on internet and TV, and no load, no load. That is the way to go. No load. Let me tell you that right now. If at all possible, you want to go no load. What does that mean? It basically means commission or charge. So loaded funds will have a fee up front. So let's say you got $1,000 and you walk into a bank or you walk into your investment advisor or even online, you find something like that, and it says 3% load. So what that means is you put your $1,000 in, and 3% just goes up in smoke. Poof. $30. It's $1,000. 3% is $30, just gone. That is the load. So you're only investing, $970 into your investment. So, it usually and typically loads are required as part of a commission structure. And as I mentioned in my introduction video, I was a Series 7 stockbroker. And partially how I got paid was through loads. So they are a way to compensate the individual who is selling you the mutual fund. So keep that in mind. But I would also say for most of us, the thing that you want to look for is those no load funds. And there's plenty of absolutely fantastic ones out there. Expense ratio. And we'll move on to our last one on this page. Expense ratio, or you might hear expense, those terms kind of interchanged here. But the expense ratio is really the ongoing maintenance charge, if you will, in a percentage term that it takes to run that mutual fund or that exchange traded fund. Think of it that remember I said there's thousands of stocks, potentially in these. Someone, either a human being or a computer, is managing what stocks are in there on a daily or hourly or minute basis. And you need to pay for that. You do need to pay for that. But you do want to make sure that whatever you're doing, whatever mutual fund that you're looking at, whatever exchange traded fund that you're looking at, you are looking at these two items. Is it no load or load? And remember, you want to go no load. And what is the expense ratio in comparison to other ones? Shop around. As we learned in the readings, that the simplest fund in the world to manage is an S&P 500 fund. A computer can do that very, very easily. Yet some companies will charge up to 1% for that. Other ones might charge only a third of a percent to do that. And it's the same thing. It's exactly the same thing because a robot is doing exactly what that index requires. And they're exactly the same fund. Why would some company charge 1% and the other one charge only a third of a percent? Well, the company charging 1% probably has the ability to do so, and probably people willing to pay it. And it might be locked in. It might be one of your only investment choices in a retirement plan that your employer offers. So that's there might be a choice in there. I'm not saying if you aren't given any choices, would you avoid it? No, I wouldn't say avoid it, but be aware of it. Especially if you can go to a little bit lower expense ratio fund. So keep that in mind because those expense ratios, they take that you're paying someone else, to do this work, to do that manage those stocks that are in that bucket, of that mutual fund, and they should be compensated. By how much, that's up to you. Um, all right, so let's go on to our next page here on investment basics. Diversification. That goes back to the old adage of not having all of your eggs in one basket. Again, this is what mutual funds are fantastic at for the average person. You can get diversification with only $100, where it's impossible to do that if you were to buy individual stocks, because many stocks even cost more than $100. You wouldn't even be able to buy one. So per share, you got to buy a full share. Diversification comes built in with mutual funds, even the worst ones, even the worst mutual funds out there, because they're not all the same. They all have different, like I said, kind of branding, on what their goals are to do. But you're able to participate in a lot of different types of stocks. Why is diversification important? Well, I don't want to bore you with a lot, but I'll probably will bore you with a lot. So diversification. Um, Not all parts of the economy, whether it's the world or whether it's domestic, are hitting at the same time. So sometimes technology is doing great. Sometimes biotech is doing great. Sometimes some of the classic industrial things, car manufacturing, might be doing great. And not knowing which one is going to be doing great when, because let me tell you, no one knows. Anybody who says they know what the market's going to do, run away. Again, there has been people who've tried to predict this over the years. Even the smartest, brilliant minds can't predict it. Yeah, you always hear the stories, the one or two stories about the person who made $1 billion out of the stock market. But there are 10 million stories out there about people who lost everything in trying to speculate the market. Okay, so that's a little piece there. But the diversification allows you to take that kind of guesswork out of it, having these various sectors of the economy or even the globe, even the world within your investment portfolio. And what's kind of cool about it, and there's actually a guy won a Nobel Prize on it, is that you can get the same returns with less volatility by having these various sectors kind of play against each other. So one goes down, the other one goes up. It does have a nice smoothing effect. When you look at how your portfolio will grow. Now, obviously, diversification comes in different flavors, and how smooth that ride is depends on what flavor that you're choosing, and we'll talk about that at the end too. But know that diversification is absolutely essential. You've got to have diversification in your portfolio. Otherwise, you're a speculator. So, and mutual funds and exchange traded funds are the best way to get diversification relatively easily. Okay, types of mutual funds. So, I've been talking about it as we've been going through mutual funds. There are a ton of different types out there. Again, each one has its own kind of marketing spin to appeal to a certain type of investor. Um, the ones that we've talked about in this class and the ones that have been, I guess, recommended for you to really look at are what we call index funds. So, what's an index? Well, an index is basically a snapshot of the market. And what is the market? Usually, the market, when we say the word market, that is the US stock market. Um, and the stock market, there's a couple of stock markets. There's NASDAQ, there's the New York Stock Exchange. Those are the two biggies out there. And basically, it's when we say the market, it's those, where stocks are traded. You have to actually go to a place, electronic mostly nowadays, but an electronic place where people buy and sell these stocks. But an index is a snapshot of a certain segment of an economy or a stock type that's taken. There's all kinds of indexes out there, tons of them. But the ones you're going to hear about all the time, and the ones that we talk about in the text, one is the Dow Jones Industrial Average. So what is the Dow Jones Industrial Average? Or you hear the Dow. You hear this every day on the news. The Dow. They'll talk about the Dow and they'll talk about the S&P. What is the Dow? The Dow Jones Industrial Average is the top 30 U.S. stocks in the country. So it's whatever top 30 of them are. Now, top 30 by what? That's the other question. Top 30 what? Top 30 fast growers? Top 30 ones that made the most money? No, it's the top 30 in size, how big they are, how much they are valued. The top, biggest companies in the United States. And when you make the Dow, it's a big thing because there's only 30 of them. Okay, and we'll look at some of the names that are on the Dow as of the date I made this lecture. And people fall off and fall off, fall on and or go on and fall off. Kodak being one of the classic ones that was on the Dow forever and now it's completely gone. But so you have the Dow, and it's really how big they are. And the other one is the S&P 500. Similar to the Dow, each one has its own little, computational um, uniqueness to it. But in general, the S&P 500 are the 500 largest companies in the United States. That's other big deal. When you're an S&P 500 company, you're kind of a big boy. You're at the big boy table when you're an S&P 500 company. And there's S&P 50s, and there's S&P 1000s, but it's basically the top 500 in the country. Let's take a look at what some of those stocks are as of today. So right now, when we're looking at what's on the Dow, the largest company right now is Apple, and that is based on its size, its value in the market. So if I said if I wanted to buy Apple, how much money would I need to do to buy Apple? And theoretically, you could go out. I don't know what their value is of the day, but let's say it's $1 trillion. If I had $1 trillion, I could theoretically buy all the stock in the market and own Apple. So you can see these are alphabetically listed here, but these are the Dow top leaders. But Apple, as of the last time I looked, I think was at the top of the Dow as well, both alphabetically and in size. But you can see these are all companies Caterpillar, they make the big digging equipment, and Boeing and Microsoft and Merrick, Walt Disney, Walmart, obviously, all of these big companies in here, Procter and Gamble, big well-known names. Those are in the Dow. So if you bought an indexed fund that was the Dow, you own a little chunk of all of these, which is kind of cool. Big companies. Are all of these going to go bankrupt? No. A couple of them might. Couple of them, probably a lot of them are going to do really well. So that's what's kind of nice about owning an index fund. Again, you own all of these 30 companies in one felt swoop with a $100 investment. You can't even buy one share of Apple for $100. So you'd be able to buy little portions of a share, fractional shares, theoretically, with your mutual fund investment. The S&P 500, again, this is another, basically the top 500. Again, names very similar. The Dow and S&P will be very similar, but the S&P is going to be the top 500. Here are just the top 10. So, Apple, Microsoft, Facebook, Amazon, Johnson & Johnson, Berkshire Hathaway. That's probably one name you don't know is Berkshire Hathaway. They own a huge portfolio of companies that you would recognize, big companies, and also, again, they're kind of behind the scenes in a lot of insurance companies. So that's again one. If you're ever curious, you can go and Google that and see what's in Berkshire Hathaway. Another name that you might hear affiliated with Berkshire Hathaway, it's frequently in the news, is Warren Buffett, because he's sort of the master of all of this and has been for many, many years. And he has a true gift for investing in some of these companies. And there's literally, I mean, they may own, geez, I would say over 100 companies in their names. I will give you a few of the names that jump out to me. Oh, let's see. They own Duracell, Dairy Queen, Geico is a Berkshire Hathaway company, Helzberg Jewelers, just all kinds of companies that are completely unrelated, but they own them. Even Pampered Chef is in there as well. So there's a ton of companies they own out there. Those are the familiar names, but the entity, the ownership entity behind the scene is Berkshire Hathaway. All right, so I kind of digress there, but we couldn't have an investment class without talking about them and talking about Warren Buffett. Now, Warren Buffett, his what he has done with that company is he is actually his whole thing was about diversification. So even in the companies he owns, he diversifies that. So he plays on a much larger field than any of us. But instead of owning individual stocks, he will go out and grab entire companies that are in different areas. Okay, so there's my Berkshire Hathaway. I'll get off my soapbox there. But Exxon, you can see these are also in the S&P 500. What you want to remember about the indexes is that, again, they are all driven by a computer. A computer can figure out what the largest companies are, the Dow, or the S&P 500. You do not need to pay people millions of dollars to figure out how to buy and sell and invest in an index fund. That is why they are typically so low in cost structure. What cracks me up, and this is ultimately kind of why I sort of disconnected from investing in general, is that these individuals, these fund managers who made millions and millions and millions of dollars in managing these funds, could not beat, and it's been proven time and time and time again, they cannot beat the indexes. They cannot beat the indexes. Oh, every now and then one will have a good year, maybe two, maybe three, but that's it. Long term, big perspective, they don't beat the index. So why do you pay these people millions and millions of dollars when a basic computer program can beat them by just investing in the top 500 companies in the United States traded on the two major stock exchanges? So that's kind of one of the themes that is through here, through our class, is that you do not need necessarily these high expense ratio mutual funds. Index funds are truly, in my belief, the way to go. And even Warren Buffett recommended to his children, hey, when I'm not around anymore, just go invest in an index fund, an S&P 500 index fund, because yeah, I might be better than the S&P 500, but historically, no one else has proven to beat him. And he does, and what he does is completely on another different level. Um, so yes, so that's something to keep in mind that nobody can consistently beat the S&P 500. So why not let the robot do it and just choose the top 500 companies and buy a mutual fund that's an S&P index fund with a very low expense ratio?